In addition to recognizing income on the income statement from discontinued operations, there's also the impact that needs to be recognized in the income statement of actually selling the assets and generating a gain on sale. So dispositions also create a gain or loss on sale, and that's going to be recognized separately on the income statement. The gain on sale depends on the book value of the disposed assets. And once we forecast from a forecasting perspective, the dollar amount of dispositions need to be forecast, and we can use the reported gains on sale on past dispositions to help us guide what the estimated gains on sale is going to be on forecasted dispositions. So as an example, disposition proceeds of $200 million. If we assume by looking at the historical ratio of gains on sale as a percentage of total past proceeds with 75%, well, the implied gain on sale that would be recognized on a forecast basis on the income statement is $150 million. And that means that we are estimating that if we sell something for $200 million, and in the past, the gain on sale as a percentage of total proceeds has been 75%, well then 75% of $200 million is $150 million. That's the gain on sale, which implies that for a forecast of 200 million dispositions, we're forecasting also, and this is going to matter when we get to the next slide, that also means that we're forecasting that the book value of the assets that we're disposing of are going to be $50 million. It's going to be $50 million at the time of the sale. So let's actually flesh that out a little bit further. In terms of the effect that these dispositions have on the balance sheet, it's actually very important to understand the impact to the book value as well as the gross carrying value of the assets. So assets on the balance sheet, if we all remember, are recorded at their gross carrying value net of accumulated depreciation. And the term for that is net book value. When assets are sold, their impact must be removed from the balance sheet. So we can calculate the book value of the assets as proceeds minus the gain on sale. So that's what we just done. In our prior example here, we said the proceeds were $200 million. The gain on sale is going to be $150 million, which we sort of look at the historical ratio to guide us, and that can enable us to back into the implied book value. So that's what's going to be removed on a net basis from the balance sheet. But there are actually two things that are being removed from the balance sheet when you remove an asset. The removal of the gross carrying value, the original purchase price of the asset, as well as all of the accumulated depreciation. So it's actually the two things that are netted against each other that amount to 50 that are being reduced from the balance sheet. So we're going to have to make yet another estimate when we want to really understand what is the balance sheet impact of these dispositions. Let's assume that book value represents 80% of the gross carrying value. And we can look at that by looking at the historical relationship of assets that are sold, sort of the historical relationship of book value to gross carrying value of previously sold assets. And let's say that on average over the last several years, assets that are sold have had a book value to gross value ratio of about 80%. Well, with that forecast, we can back into what the implied gross carrying value is of dispositions. That means that an asset that we're selling that has a book value of $50 million, we're forecasting has a carrying value, a gross carrying value of $62.5 million, which by definition implies that accumulated depreciation that's going to be removed from the balance sheet is 12.5. Just bear in mind that these two net out to the impact of 50, but they are comprised of two different elements, and that's going to matter when we forecast our balance sheet. We're done with the conceptual introduction to modeling these segments. In the next video, we're going to turn to actually building the model.